Enphase Energy is down by almost 35% over the past year, and currently they're trading very near their 52-week low. The company specializes in manufacturing solar microinverters, battery energy storage, and electric vehicle charging stations. And with the increased sentiment to change everything gas-powered to electric power, this company has enormous headroom with very high growth potential. And so today we will figure out whether you should buy the company right now for great return or whether you should wait for it to drop even lower. And to do this, we will of course use our stock valuation spreadsheets, where we'll have a look at the fundamental 9-pillar analysis and calculate the intrinsic value of Enphase using our 4 valuation models. Now to start off, Enphase is quite a new company. They entered the stock market in 2012, so they currently don't pay out any dividends. And I think that them not paying out any dividends is very smart from them, as they still need to direct a lot of their free cash flow into innovation. Another thing I like about the company is the difference between their market cap and their enterprise value. We can see that the difference is very low, which tells us that they have very low debt. They also have a positive equity value, which means that they have more assets than total liabilities, and tells me that they know how to manage their financials. And now let's jump to the 9-pillar analysis, where they get a rating of 5 out of 8. Now, as Enphase is a new company, I'd expect them to have very high growth, but trade expensive compared to their earnings and their free cash flow. And we can see that that is indeed the case. We can see that their 5-year P ratio is sitting at 126, while we want it to be anywhere below 22.5, and their price to free cash flow is sitting lower at 29.52, but we want that to be below 21. Now we can have a closer look at these two metrics. We can see that the current P ratio is actually sitting at $162.16, which is very expensive and means that investors are paying $162 for every dollar of the company's earnings. Now this is not the same story with the price to free cash flow, which is currently sitting at only 17.44, which is much lower than its 5-year average. Now you all know that I love when the price to free cash flow is lower than the PE ratio, and that's essentially because the free cash flow is the company's blood. It's used for innovation and developing the company. It's used for share buybacks, paying off debt, etc. So it's much more important than the net income of the company, which is used to calculate the PE ratio. And so even though these two pillars are currently sitting in the red, and yes, I'd like them to be lower, the current price to free cash flow is sitting very low, which makes me quite happy. Now let's turn to the growth of the company. So we can see that their revenue has been growing at a rate of almost 25% yearly over the past 5 years. The free cash flow has been growing at an enormous rate at 57% yearly, and the net income has been growing at 17.87% yearly. And this is again what I said, I like the free cash flow growth to be higher than the net income growth, which it is with Enphase. And if we have a closer look at the 3 pillars, we can see that the revenue has been growing extremely well over the past 5 years. The net income has been growing as well, and the free cash flow has been growing as well. And as expected, the free cash flow is higher than the net income. Now before we continue, I just want to say these spreadsheets are very useful to both beginner and advanced investors. Whenever you see a company on the internet that interests you, you can simply jump to these spreadsheets, plug in the company's ticker, figure out its intrinsic value, and go through the 9-pillar analysis and understand whether it is worth researching this company further to possibly add it to your portfolio, or whether the company is simply not worth your time. And currently we are running a Christmas discount. You can find the discount code in the description. It's a discount for 20%, and if these valuation spreadsheets interest you, you can pick them up right now. Now jumping back to the 9-pillar analysis, let's have a look at the remaining pillars. We can see that the company's 5-year profit margin is currently sitting at 41.65, and if we have a closer look, we can see that that has actually been increasing at a rate of 6.11% yearly. Now we know that the company's profits are increasing and their profit margin is increasing as well, which gives them a great starter point for exponential growth over the next few years. Now we also want to have a look at their decreasing shares outstanding, and we can see that Enphase has actually been selling out shares at a rate of 0.82%, which is fine with me and was actually quite expected, as they are a new company and they do need to generate a lot of free cash flow to direct into things like innovation, which they do by selling out shares. And for the final pillar, we have a look at the long-term liabilities over the 5-year free cash flow negative dividends to be below 5. And this pillar tells us whether Enphase generates enough free cash flow to cover all their long-term liabilities to not get into trouble with debt. And we can see that the ratio for Enphase is sitting at 0.74, which means that they can pay off all their long-term liabilities with their current free cash flow in about 3 to 4 years, which is great. So Enphase is looking quite well, taking into account that they are a new company. Obviously, I'd like the PE ratio to be a little lower, but to me they make up for it with their revenue, free cash flow and net income growths. But let's now jump to our intrinsic valuation models and figure out Enphase's intrinsic value, and first using the grams formula revised. And here to calculate the intrinsic value, we have to take the 5-year earnings per share and the base P of the company. We then have to calculate the 5-year earnings growth estimate, which we do by plugging in our high earnings per share growth estimate, our medium earnings per share growth estimate, and our low earnings per share growth estimate, and calculate a 5-year earnings growth estimate of 36.75% yearly. We then take the growth rate multiplier, the average yield on AAA corporation bonds, and the current yield on AAA corporation bonds, and get an intrinsic value of $116.34, which is almost 40% higher than the current trading price of the company. Now jumping to the second valuation model, the discounted cash flow valuation, where we take the free cash flow of the company over the past 5 years and calculate an average growth rate of 56.89% yearly. Now using the same method as before, I calculate the future growth rate of 26.7% yearly over the next years and calculate the future free cash flow. I then plug in a discount rate at 12.12%, which is essentially the minimum rate of return I want yearly from this company, and calculate the present value of that future free cash flow. I then sum all of that up, add cash and cash equivalents, and subtract total debt to get an equity value, which I divide by the shares outstanding and get an intrinsic value of $121.60, which is quite higher than the current trading price. Now jumping to the multiples valuation model, where we compare Enphase to one of its competitors, MKS Instruments. We take the company's current stock price and divide by their earnings per share to get their PE ratio, which we multiply by the earnings per share of Enphase and get an intrinsic value of $111.11. And this essentially tells us that in this time, compared to its industry, Enphase's PE ratio isn't actually looking all that bad. Now normally we would also have a look at the dividend discount model, but Enphase doesn't pay out any dividends, so we will skip this one and arrive straight to our ultimate valuation, where we average out the 3 valuation models and get an intrinsic value of $116.35, which is 63.07% higher than the current trading price. And so if we plug in a margin of safety of 20%, we still get an acceptable buy price at $93.08. And so yes, even though Enphase is currently trading quite expensive, I do believe that they will go up in price a lot in the next few years. It is certainly a slightly riskier investment, but the riskier investments always have the potential to bring even more return. And with that, I hope that you enjoyed the video. Make sure to leave a like and subscribe, as it really helps me out.